let's skip the fluff today. I'm dropping my exact, actionable institutional execution plan for gold, XAUUSD, for the upcoming week. Zero guesswork. This explainer is your direct blueprint.
This week, I am looking to sell gold, period. My ideal entry zone is precisely between $4,190 and $4,215. My hard stop loss is set at $4,245. My first take profit target is $4,120. My second take profit is $4,055, and my final macro target is the $4,000 psychological level.
This setup gives us an incredible risk-to-reward ratio of about 1 to 3.5. We are stepping in with one primary objective, hunting down that massive, unmitigated pool of sell-side liquidity sitting right below the 4,050 level.
Section 1. Institutional reasoning. Let's look at exactly why this trade makes sense.
I don't guess the direction, I track smart money. Look at the weekly time frame. After hitting that all-time high near $5,600, we got a massive structural shift down. Right now, price is pulling back deep into discount pricing, dropping directly into a major weekly bearish order block and a fair value gap sitting right between $4,000 and $4,200. The long-term gravitational pull is undeniably down.
Dropping to the daily chart, you can see a crystal clear bearish break of structure. Notice that recent short-term rally up to $4,400? Price perfectly rejected the premium fair value gap and the daily order block at that exact level. Smart money heavily defended those premium prices to trap retail buyers, and now we are expanding aggressively back down.
Drilling into the H4 time frame, our target map becomes obvious. They've engineered internal buy-side liquidity around $4,200 and $4,250. But the real prize? The massive external sell-side liquidity pool resting like a giant magnet completely unprotected beneath the $4,050 swing low. That is exactly where price inherently wants to go.
Section 2. The execution plan. Having a bearish bias is completely useless without a rigid set of rules.
Here is my exact execution sequence. Step 1. I am only executing the short position during the high-volume London or New York kill zones. Step 2, I must let price retrace up into my specific point of interest, that 4,190 to 4,215 zone, which holds our H4 and H1 bearish fair value gaps. Step 3, once we're inside that zone, I'm watching for a minor internal liquidity sweep to confirm the turn, and then I execute.
Let me be absolutely clear about this. If there is no retracement, there is no trade. As of the market open, there is currently no valid setup. Price must pull back into that specific H4 and H1 fair value gap. If price drops and leaves us behind, we sit on our hands. We do not chase, we trade the plan, or we don't trade at all.
Once I'm tagged into the trade, here is my management strategy. At take profit 1, $4,120, I'm taking partials. This level is internal structural support and holds a minor liquidity pool, so securing profits here protects our capital. Take profit 2 is $4,055. This is the major daily sell-side liquidity target, where the bulk of my position comes off. Finally, take profit 3 at $4,000 targets the macro psychological round number.
Section 3. A lesson in patience. Before we get into contingencies, we really need to talk about execution discipline.
Mapping this exact $4,190 entry is easy. Having the ice-cold discipline to wait for it is where retail traders fail. Let me share a story about a trade early in my career that cost me thousands purely because I couldn't wait. I was stalking a gold setup, identical to this. The higher time frame was screaming sell, institutional order flow was bearish, and the sell-side target was glaringly obvious. I had my premium point of interest marked out, just like our $4,190 zone. But right at the open, price immediately started bleeding lower. The hourly candles looked heavy. I watched it drop $5, then 10. My chest tightened. I thought, I can't miss this drop. I'll enter early. The momentum is too strong. It'll never retrace to my entry. Driven entirely by FOMO, I panicked and slammed the sell button in the middle of nowhere. I completely ignored that internal buy-side liquidity hadn't been swept. For the next 3 hours, I sat in agonizing pain as the market drifted into a slow consolidation. Then, right at the start of the New York session, a burst of algorithmic volume spiked the price straight up. I watched it rip right through my premature entry, hunt the buy-side liquidity exactly where my original premium zone was, and stop me out for a massive full loss. Within minutes, it reversed violently and melted down to my exact macro target. I was right about direction, but lost serious capital because I lacked the patience to wait for my precise point of interest.
That right there is the defining difference between retail FOMO and institutional patience.
I learned the hard way that chasing price is a fool's game. Think about that painful lesson when looking at this week's setup. Institutional order flow dictates that we absolutely must wait for the $4,190 to $4,215 retracement. Do not let the open trick you into early entries. Let the market come to your terms.
Section 4. Next week's checklist. You must be prepared for whatever the market throws at you.
A professional trader operates on contingencies, so here is exactly what I will do. Scenario A. If price reaches $4,190 to $4,215, I execute my sell position targeting that sell-side liquidity. Scenario B. If price never retraces and just tanks straight to the target, I do not enter. I protect my capital and wait for a new structural setup. Scenario C. If we get a daily candle closing above $4,250, this bearish setup is entirely invalidated, and I immediately switch my bias to look for longs. Scenario D. If high-impact news creates a wild manipulation spike, a Judas swing, I will calmly wait for the sweep into my zone to finish before hitting sell.
Let's look closer at the H1 chart. My absolute line in the sand is drawn exactly at $4,250. If we get a strong daily close above that level, the entire bearish structural narrative we just built is destroyed. Until that happens, any push higher is just a premium mitigation, offering us a much better price to get short.
You also need to keep a close eye on the economic calendar this week. Tuesday brings flash PMIs for Europe and the US. This is the perfect algorithmic fuel for a Judas swing. It could pump price up to sweep that 4,200 liquidity. Then on Thursday at 7:30 p.m., we have the US core PCE data. This is the Fed's ultimate high-impact expansion catalyst. I am strictly warning you, do not execute new positions exactly at 7:30 p.m. on Thursday. Avoid that massive spread widening. Let the initial volatility settle and trade the expansion that follows.
Section 5. Final thoughts. Let's wrap up this execution plan.
Remember the golden rule. Plan the trade the plan. Manage your risk. Never risk more than 1 to 2% of your account equity on this setup. The market does not care about your feelings. It only respects flawless discipline. We know the direction, we know the institutional levels, and we know our targets. Now we just need the patience to let the trade unfold.
Listen, if you want to stop guessing and start executing structured institutional trading plans exactly like the one we just broke down in this explainer, you need a broker that can actually keep up with you. I highly encourage traders who want to utilize these precise high-level approaches to open an account with FXTM. When you are waiting for price to tap a very specific premium array, you absolutely cannot afford slippage. FXTM provides the tight spreads and reliable, lightning-fast execution speeds required to enter cleanly. Follow the plan, manage your risk, do not chase the market, and I will see you in the next explainer.